Well, thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Kotak Institutional Equities, or rather Kotak AMC, excuse me for that gaffe, back in 2019 had put out a note or had given a call to go overweight equities. The last call that I read from them in July is of neutral weight on equities at large and underweight on mid caps and small caps. The man in charge of all equity decisions at Kotak Mahindra, Kotak AMC, is Harsha Upadhyaya, and he joins us right now on Talking Point to talk about why is it that he has given out this call at the current juncture. Harsha, so good having you. Thanks for joining in. I hope all is safe.
Yes, Neeraj, all safe, and hope you as well as your audience are staying safe.
Yeah, I hope so too. The audience should be safe. We are coming down on the cases, which is a great thing. But Harsha, to the moot question, um, is this call of going neutral weight equities, which is of course not meaning as you explained that update as well, that people should go out and sell equities, but not maybe trim positions if they go overweight, etc. But is this call a factor of uh, things not looking great around the world, if you will? Or is it a factor of earnings growth not showing as much promise as it probably was expected in the month of January for FY22? Is it a combination of both, or is it something else?
It's neither, I would say, Neeraj. It's more to do with the valuation. We do expect cyclical recovery to gain momentum. We hope that there is not going to be another wave of COVID in India. So to that extent, economic activity will certainly normalize as we go forward. And you may have some positives and negatives from the external environment. That is anyways part of the markets at all points of time. But when we look at valuations now, valuations are close to about 21 or 22 times 1 year forward earnings, which is well above last 10 years average, I would say. But as long as earnings momentum is continuing, this kind of valuation will sustain. But we believe that June quarter is going to be softer than what everybody anticipated in the beginning of the financial year. So to that extent, there could be some pause in the earnings upgrade cycle that we have seen in the past. If you look at September 2020 onwards, every quarterly result has surprised on the positive side, and we have seen numbers getting increased at the earnings level. We believe that maybe after the June quarter, that upgrade cycle could be kind of will show some amount of pause, and that's the reason why we are saying that at this point of time, maybe it's worth looking at trimming equity positions if you are overweight. It's not a sell call on equities. It is just that to moderate your asset allocation at this point of time.
Yeah, sorry, I just want to correct what we put out. They are not underweight equities, Kotak AMC. They are neutral weight equities. They are underweight mid caps and small caps. So just make that small clarification here. And Harsha just beautifully explained the reasons thereof, and valuations being the key one. So Harsha, you reckon? I mean, because I'm just trying to understand, because mid caps and small caps are such a wide bucket, therefore to give a valuation metric to that index is a bit difficult, simply because there'll be so many pockets out there which would not be um, for lack of a better word, expensive on the valuation front. Now therefore my question to you is, um, are you now becoming a lot more selective and a lot more bottom up as opposed to thematic that you may have been, say, 1 year ago?
Yes, that's exactly our point is. I think as valuation gap between mid caps and large caps, or small caps and large caps have breached quite considerably in the recent past, in the last 12 to 18 months. And you look at any of the other metrics, all of them show that mid and small caps have had a great run. And to that extent, one needs to be more selective. Yes, you are right that if you look at mid cap index or small cap index, there is a large basket of companies which are still showing losses. And once these turn into positive numbers, there could be further upside in mid and small caps, but that would be dependent on the trajectory of the economic recovery. And as it gains more momentum, we will have a better handle on that. But at this point of time, I think if you look at last 12, 15 months, the kind of underweight people were on mid and small caps was also one of the reasons why we were so bullish, given the under ownership in mid and small cap. I think that has also kind of corrected in the last 12, 18 months. And now the valuations also seem to be quite fair. So that's the reason for taking underweight, which is a more tactical in nature on mid and small caps. We are not completely negative on mid and small caps, but we believe that at these valuations, the risk reward is not in favor of somebody who is looking at large lump sum investments into mid and small caps. Hence, whoever is wanting to invest into mid and small caps should go in a gradual way and make more staggered investments over the next 6-9 months rather than making lump sum investments at this point.
Well, that's really sane advice. Stagger it out. SIPs usually work very well. Harsha, I'll divide this conversation therefore into two. One is pockets which are both large cap and mid cap and small cap components being there in those themes, and some in which there is largely a mid cap presence, right? First, talk about the former, and the chart from your AMC update was beautiful because it shows how some of the sectors or themes YTD have performed. Let's talk about each of these, or two or three of these, one by one. Metals, splendid performance, YTD 60%. There are some people who believe that we've now reaching a peak in the metal cycle because Q1 profits would probably be equal to maybe even FY21 profits, what have you. And the sector is a peppering of large, mid, small, public, private, or other PSU and private companies, all of that. It's a smattering across, right? And ferrous and non-ferrous too. Now, how are you repositioning yourself out here, if you will? And take your time to answer. We would love to understand from you ferrous, non-ferrous, and large, mid, small, whatever. It would be lovely to understand your thesis here.
Neeraj, we continue to remain constructive on both ferrous as well as non-ferrous metals at this point of time as well. It is more like an equal weight to slight overweight in most of our portfolios. The thesis is after a long time, there is pricing strength that we are seeing across commodity baskets. We are also seeing a large decarbonization move from China, which means that many of the capacities will not be running at this point of time. And also in future, only after some sustainable investments that they make, they would be looking to really ramp up that production, which means that global demand supply situation is in favor of manufacturers here, which means the pricing strength should also continue. And more importantly for Indian metal manufacturers, we are seeing a significant amount of deleveraging in the recent quarters. This has been purely led by lack of capex that has been done in the recent past, and also the kind of cash flows that you are seeing, given that most of the metals are at all-time high in terms of prices. And we expect definitely some volatility to kick in because just like equities, commodities are also quite non-linear in that sense, and they may not continue to have a similar kind of pricing strength always. But nevertheless, given the kind of deleveraging that has already happened and that is expected to happen in the next few quarters, this sector is definitely one of the sectors which will deliver better than expected earnings growth when you look at various other sectors in financial year 22. And also, the ownership is not very large in this particular bucket. So overall, we continue to remain reasonably positive on metals, and it is one of our exposures that we would like to continue.
So Harsha, would it be safe to assume that maybe the stock prices hitherto followed the price movements in the underlying commodities? Now if the underlying commodities consolidate stroke correct, but earnings growth looks positive, deleveraging start, or rather accelerated deleveraging starts, then we might actually see stock prices follow those events as opposed to the corrective moves that might happen from time to time in the base commodities.
Neeraj, it's difficult to predict because usually whenever you see volatility in the commodity prices, the companies which produce those commodities also have some volatility in the stock market. But you put it very well in terms of explaining that even if there is some worsening of prices, that is not going to impact the fundamental revival that we are seeing in the industry, and especially when it comes to some of the Indian metal companies. And to that extent, their profitability will remain much higher than what was there for the last several years. And also on the capital structure, they're beautifully placed now. The improved cash flows over the next few quarters will definitely bring down leverage further, and which will add to profitability, and also the strength in the balance sheet, which will allow them to take on new capex whenever it's required in the next few years. So overall, I think they're placed quite well.
Got it. The other pocket, Harsha, and very large and diverse, is autos. Would love to understand your view there. Autos, auto ancillaries, because auto companies, since we were talking about metals, I thought of autos. Since they have had to negotiate those price hikes with the steel companies and had to accept high prices. At the same time, while we may be partially locked down, what have you, the feeler that we get from company conversations is that auto component exports have looked very robust going to the West. What's your thought here on this pocket? Valuations, growth numbers, and domestic versus export plays?
On auto and auto ancillaries, we have been more selective in the recent past. We do have some positions, but we are watching the space, given that one cannot still predict how strong is going to be demand revival in the immediate term. From a medium-term perspective, we all know that the penetration of vehicles in the country is quite low, and there is going to be higher affordability, and hence you will see more vehicles being bought. But in the immediate aftermath of second COVID wave, we really don't know how discretionary demand, especially at the higher end, will pan out. One cannot use the same template that we had used after the first COVID wave, because it was less emotionally dragging for most people. And this time around, it's been more severe. And to that extent, there could be emotional scars which will not let people to really go out and make large discretionary purchases. So that's on the demand side. And as far as the supply side is concerned, at least some subsegments of autos have seen some amount of pressure, because especially passenger vehicles, given chip shortage, etc. And more importantly, as volume improvement is going to be more gradual, we will also have to take care of the commodity price headwind, which is definitely going to be there in the June quarter, as well as in the next few quarters. So until unless demand really revives in a very strong way, pricing flexibility for auto manufacturers is quite limited. So we may have a situation where the margins are also under some sort of pressure. So that's where we have been selective in the auto basket. And as far as auto ancillaries are concerned, there are a few auto ancillaries where the order book is strong, where the growth has been coming back visibly. Those are the names which we have been betting. But overall, if you ask me, it's still an underweight in auto ancillaries, and we have been more selective in terms of our exposures.
Okay, now to the other leg of the commodity basket. And again, there was this lovely chart on your monthly market update which showed how agri commodities have just come off quite rapidly after making a really sharp up move. I think a lot of people were of the opinion that agri commodity prices will just not show any kind of corrective move because of weather patterns the world over, so on and so forth. For now, that seems to be proving to be false, if you will, if you look at this index. What's your sense there, and how to play that, Harsha? Because this, as I said, would largely be a mid-cap dominated pocket, right? Maybe a company or two or a handful of companies in that large cap space. Otherwise, largely dominated by mid-caps, if I'm not wrong.
Yeah, our focus here has not been to really look at only the agri commodity producers. We are also looking at some of the users of agri commodities, especially the foods companies, etc., where there was some margin pressure that was building up in the recent past because of the high prices. I think there is some sense of normalization there, which should help for some of the FMCG company margins going forward. But that doesn't really mean that we will be going overweight on FMCG or increasing a lot of exposure there, because the thesis there is, while these companies have been quite resilient all through the COVID phase and also likely to be doing the same going forward, the valuations more or less seem to discount all the positives there. We would rather look at cyclical buckets to increase our incremental exposures, rather than looking at some of the defensive sectors as FMCG or even IT for that matter. So overall, yes, inflation is going to see some downward pressure because of agri commodities cooling off, which should be good for overall equity basket in terms of valuations.
Okay. Harsha, we are in the midst of, or rather the start of the earnings season, sorry, not in the midst of. And this week is dominated by IT. We've seen TCS numbers come out already. Infi Wipro come out this week, HCL Tech 99, a bunch of mid caps too. Um, and I saw, I mean, I was doing this small um, um article in which I saw that if you look at the last 5 years, and I'm sure you know, but I'm just reading it for the audience benefit, the last 5 years, the kind of gains that some of the mid-cap IT companies have done, both in terms of prices and valuations, far outweigh the gains in the large caps, including TCS, including Infosys. Now, what's your sense on IT? Because the ISG survey suggests that things are looking rosy. Valuations for some companies are very high, some are not. Uh, what are your basic thoughts, and how are you playing this basket?
We continue to have more or less equal weight to IT industry, but incrementally we are not looking to add more exposure here. The reason being, while the business momentum continues to be reasonably strong, some of the factors which helped IT industry to give much better returns than the overall market seem to be absent. For example, last year around the same time, it was a sector which was quite under-owned, which was ignored by most institutional investors. And when the turnaround happened, obviously there was a significant amount of money that flowed into the sector, which led to the stock performance that we have seen, especially in the mid-cap IT. Now that under ownership doesn't exist. Secondly, from a valuation perspective, this sector was somewhere close to market multiples or slightly lower than market multiples over the last several years. But now currently it's well above the market multiples in terms of valuations, and more or less fully discount the kind of upside that we are seeing in terms of business momentum. And there are some known headwinds in terms of cost pressures. For example, this quarter and next quarter, we could see some of the margins getting hit because of the seasonal wage hikes that companies would do. And also the fact that some of the costs may come back once in a post-COVID scenario, things will normalize. For example, travel costs is one large cost element which has virtually gone down to zero for the IT sector and which has helped the margins, will come back at a certain point of time in the next few quarters. Given all this, we believe that the valuations currently don't have much room to re-rate from the current levels. And if at all there is any a pressure in terms of earnings growth or on the margins, then we would believe that the stocks may start to derate from these levels. And especially when you look at mid-cap IT, last year, as I explained, there were several factors such as under ownership, etc., which propelled these stocks to a new high. But also from a business perspective, due to COVID environment, a lot of user industries started to do small deals and give out a small budget, which really helped many of the mid caps and small caps. But I think once situation normalizes, it's again going to be the case of large deals coming through, which means the competition for mid cap IT to again get incremental share in this business is going to be really enormous. So from that perspective, and also the fact that the valuations in many of the mid-cap IT companies is much higher than where they were historically, or much higher than even the large-cap IT names, as you rightly suggested. We believe that incremental exposure in this segment is going to be fraught with risks. So to that extent, we will stay put with our existing exposure in IT sector.
Lastly, Harsha, the buzzword seems to be around the IPOs, isn't it? This month of July, we've seen fabulous response to the closed. We have the upcoming Zomato IPO, which is kind of taken the Wall Street by storm, so to say, at least in terms of conversations and memes. What are your thoughts here?
See, clearly, IPO market is quite strong at this point of time. In fact, this month, the IPOs would raise a lot of money from retail investors as well as institutional investors. So when you look at the underlying sentiment for IPOs or for equities in general, that continues to be very, very strong. So no questions about that. But just because there are new IPOs coming from various sectors, it doesn't mean that all of them are buys and all of them will give you money. If you look at the last 10 years and see how many of those companies have sustained their businesses, how many of those companies actually have delivered returns better than market average returns to investors, you will find that that ratio is more or less similar to what you would see in a secondary market. So it's just that people believe IPO is a great way to really create wealth. But when you look at it from a longer term perspective, the risks are similar. In fact, in many cases, the risk could be higher than an existing established company which is offering secondary equity, etc. So one has to be selective in IPOs in terms of determining which are the stocks that one wants to participate and which are the ones which one wants to keep it as a part of the core portfolio. And if one can do that, I think there is a lot of opportunities that are going to come by in the next few quarters.
Harsha, before we wrap up, what is your largest, or what is your belief about what could do really well? Since you seem to be, how do I say, my sense that I get is you focusing a lot on where valuation comfort is available, while there might be growth. Where is it that you believe there is a highest probability of generating superior returns here on? Which themes?
Our belief is some of the cyclical sectors, both local as well as global, could give that opportunity. We already discussed about one of the global cyclical sectors, which is commodities. Apart from that, from an Indian context, we are also positive on cement, industrials, and banking. These are the sectors which are closely linked to economic activity, and we believe that over a period of time, there can be positive surprises in earnings of some of these companies, at least as economic activity normalizes. While FMCG, IT, pharma, etc., can give you a steady returns in terms of earnings growth, these sectors, the cyclical ones which I mentioned, can surprise you on the earnings, and that's where there is a possibility of re-rating if that were to happen. So because of that reason, we are looking to invest a little bit more incrementally into some of these sectors in our portfolios.
Okay, Harsha, we'll leave it at that. Thank you so much for taking the time out and speaking to us. And it's I repeat what I said at the start of the interaction off air. It's a lovely bookshelf that you have behind you. Keep up the reading.
Thank you. Thank you so much, and stay safe.
Yeah, thank you, Harsha. Pleasure having you today. I look forward to having you. And viewers, thanks for tuning into this edition of The Talking Point.